We had that ugly sell-off in the U.S. market on Monday. Stocks stabilizing today, but our guest says the worst is not over for markets. We are joined by Andrew Brenner, head of international fixed income at NatAlliance Securities. Andrew, thanks very much for coming on the show. You're seeing more swings, downs for equities?
Well, thanks for having me, as always. What I see is the two worst months of the year for equities are August and September. And you're only 8-9 days into August. So I think there's a lot more volatility that's going to happen. You've got the election. You still have a very stubborn Fed. Even now, as we're talking, Barkin is saying that he wants to wait until September. So there's not going to be any intermediate cuts, which I think kind of makes sense. But, you know, you had Bill Dudley come out 2 weeks ago and again this week and say that the highest the Fed funds rate should be at the moment is 3.8%, and we're at 5.3. So we're 150 basis points too high. And I think the Fed has to wake up to that and start cutting aggressively. We anticipate 5 cuts for the year, 50 and 75 between November and December. So that's where we stand. And until we get that, we think it's going to be a lot of choppiness. I'm glad we had today. I think today is more of the fact that the Bank of Japan has taken tightening off the table for the moment, so that's put some mitigation towards the yen carry trade. And I think we're probably okay for a day or two, but I still think August is going to be a lousy month, and I don't think September is going to be much better.
Has the Fed got it wrong? Did they drag their feet for too long on cutting rates?
You know, I would say yes. But you know what? I'm just one of many that are saying that. But when you had both Alan Blinder and Bill Dudley say right of the week before the Fed meeting on July 31st that the Fed should cut, you know, we're not the only ones that think that. The Fed is absolutely dragging their feet. The economy is slowing down. The employment levels are slowing down. And even though we don't see a recession, we do recognize that J.P. Morgan this morning increase the odds of recession from 25 to 35%. But we still don't see a recession, but we see a slowdown. I mean, Atlanta GDP was reaffirmed this morning at 2.9, and the Fed nowcast, which is basically the same thing, also came in at 2.9. So there is no recession, but there isn't enough inflation to justify where the Fed is right now. They really should be 150 basis points lower.
But you think these calls for a so-called emergency rate cut are overblown? You'd be skeptical the Fed would do anything like that?
You know, I gave it a real hard thought on Monday morning when the world seemed to be coming to an end. But I still came away with the conclusion that the Fed would not do themselves any favors by doing an emergency cut, because then people would think that things are actually even worse than they are. And since then, we had the claims number today. We had some good ISM numbers earlier this week, and we had 3 Fed governors basically say that, look, this isn't the time to be cutting rates just now. We're going to wait till September. All right, so let's wait till September. But let's go 50 in September, and let's make sure the market knows that when Powell speaks August 23rd at the Jackson Hole meeting.
Yesterday, I guess you're happy right now, you started moving some money out of bonds and into large caps, and it's been vindicated so far today.
Yeah, I mean, look, this market is going to go back and forth. But again, the thing that we just mentioned is the fact that the Bank of Japan looked at the equity markets, especially in Japan, where it was down 12.4% on Monday, and said, hey, you know, we're not going to raise rates if that's what these things are going to do. So immediately the yen went from 142 to I believe it's 147 right now. So that took a lot of the fear of the yen carry trade unwinds off the table. So yeah, I think we're good for a few days. But you know what? A few days doesn't make a market, and I still think that we could see new lows in the equity markets. But I will say, talking about the bond market, which is what I really focus on, I think the lows are in for the year in the bond market. 2s, 5s, and 10s, what they hit on Monday at 366, 345, and 365, that's it. You're not going to see those levels again this year.
In other words, I guess one takeaway from that is you don't see a bounce back in inflation, because that would tend to make people sell bonds.
No, I don't. I really don't. I mean, I see, look, I follow the Austin rental prices because that's one of the hottest markets, and I spend time in Austin every year. It's down 10% year over year. I mean, that's been one of the stickiest things. And if Austin's down 10%, which was a Bloomberg story earlier in the week, no, I don't see inflation rallying, and I see 2.6%, 2.5% in the PCE number, which is what the Fed focuses on because it has the least amount of distractions in that number. And I'm saying, what are you doing at 5 3/8%? So no, I see the Fed dropping rates, and even though they don't want to drop too fast because it's an election year, forget about the election. Just get these rates down.